Good morning, everybody. Welcome to our session on succession planning. When's the right time to know your succession options? I'm joined today by, my name is Paul Falvey, I'm a tax partner in BDO, and I'm joined today by Derrick Laver from Laver Wealth. This is a very important subject, often put off by people, and there's always good reasons perhaps not to do something. So it's an important subject which we hope to do justice to do today. So just ask Derrick to briefly introduce himself, and then I'll crack on with the main part of the presentation.
Thank you, Paul. Good morning, everyone. As Paul said, I'm Derrick Laver. I own and have been operating an independent advice company since March 1991, which is now known as Laver Wealth. So well as being a wealth manager, I understand many of the challenges faced by business owners. And in 2008, we developed our own in-house discretionary investment service. And you could say that our speciality is in helping our clients get the most out of their investment plans. So that's very brief. So back to you, Paul.
Thank you. Next slide, please, Tony. So the topics we're going to cover today is succession planning. So we're looking at some of the options for succession planning, which I'll run through shortly. We're going to look at one of them in quite a bit more detail, which is the employee ownership trust, which is a somewhat less well-known route, but is growing in popularity and is an important opportunity for many business owners. And when I've done my piece, Derrick is then going to talk about wealth management, what to do with the proceeds, perhaps of the sale, or how do you plan for management of your family's wealth going forward. So next slide, please. So what we're going to be talking about today are succession planning for businesses, both companies that have a share capital and unincorporated businesses, but mainly we'll focus on companies with limited by shares. It's important when we talk about this subject that we distinguish between shares in trading companies rather than shares in investment companies. So if you have a company that runs a trade, then there are many more opportunities for you, and most of the tax benefits apply to trading companies and not investment companies. So that's what we're going to be focusing on today. So we look at the various options available to you. So the first one obviously is to pass the business on to your heirs. And that's relatively easy at the moment. As I said, if you're a trading company, there's 100% relief from inheritance tax called business property relief. The situation is very benign. It's a good time to be passing on businesses to your heirs. You can generally do it in a tax neutral manner, which is extremely important. The second area is a management buyout, and this can be effective for businesses that perhaps not big enough to go down the main private equity route or trade sale route, but are certainly valuable. And the basic premise of this really is that shares are passed on to management. They'll pay for them, but maybe they'll be helped out in the terms of the sale by the existing owners of the business. So typically, there's some element of deferral of the consideration for the shares. So the owners of the business will not take the full amount of cash up front. They maybe take it out in stages, loan the money back to the company in some form. So this is very popular for smaller businesses where there's not quite the market for trade sales or sales of private equity. But you still need two fundamental things for this to be effective. You need good management you can trust to run the business going forward, and a business, of course, that generates cash and profit, because ultimately that's what will pay out the loan that you loan back to the company to facilitate the management buyout. The next area is a trade sale. Trade sale really is where you have an outright sale to a trade buyer. This is potentially, and historically has been potentially, the most valuable route. Often trade buyers will pay the most for company shares, particularly if it's a strategic purchase for them. In other words, a business that they want for some reason to get into. I've seen various examples during my career. One of them was an extremely large global brewing company, bought a relatively small brewery because at the time the global business, particularly in the UK, wanted to get into real ale, craft ale, and they didn't have a brand. So they effectively bought a brand, and for them it was a really very small acquisition. It was £20 million. This was about 15 years ago. But that would be a small acquisition for a trade buyer generally. But trade buyers will buy smaller companies, but typically they want to buy bigger businesses because obviously they need to have an impact on the profits of the company that's acquiring it, and small level of profitability won't achieve very much for them. So the next thing is private equity. Private equity are financial buyers, and they'll buy into businesses as part of an overall portfolio of having a fund. There's a huge range of deal sizes for private equity businesses. They range from 10 million, sometimes less if they're tech startup companies, to hundreds of millions or more. It's a very, very active market. It's grown hugely over the last 25 years or so. Generally in private equity, there can be a full exit or a partial exit, but it often relies on there being good management again. So management is key to all of these things. You'll see a theme emerging here. Pretty much all of these proposals or opportunities to some extent rely on good management. The purpose of private equity is they drive the business hard for growth so that they can exit in typically 3 to 5 years at a profit. So they're really only, it's not only looking, but they're pretty much only looking for high growth businesses where there's a real prospect of growing profit, which will then provide them with an exit themselves. So it needs a certain type of business. It needs to be a certain size, and it needs to have high profit growth potential to be attractive to private equity. So, and then the final one is employee ownership trusts, which I'll talk about in more detail later. But bear in mind that there's another option now in company sales and succession planning, which is the EOT, Employee Ownership Trust. So next slide, please, Tony. So let's talk about tax a little bit. The obvious point here, perhaps, is that if you take profit out of a company in whatever form, either by dividends or remuneration, you pay income tax. And income tax is at much higher rates than capital gains tax. So there's certainly a benefit in leaving money in the business to grow the business and then to ultimately sell a more valuable business and pay a lower rate of tax, capital gains. As you know, from April this year, national insurance is going up by 1.25% for the employee. So we've got a top rate of tax of 46% odd. There's various definitions of what income tax is. I'm sure you know between difference between dividend rate and income tax rate, but the key point is it's an extremely high rate now. Whilst, of course, capital gains tax remains at 20%, which is very favourable, and is also business assets disposal relief, where you pay tax of 10% on the first £1 million of gain, which covers off quite a lot of transactions in practice. That applies again, as I said earlier. The relief, business assets disposal relief, only applies to shares in trading companies. An important point. And there are qualifying conditions. You have to hold the shares for 2 years. You have to have 5% of the shares to qualify. But it is a reasonably valuable relief. As you can calculate there, it's worth £100,000 in tax. So it's not something to turn away lightly. But the far and away the best method of selling company from a tax point of view, and we should not be led by tax on these things, as I'll come on to when we talk about EOTs in more detail. But the fact remains, if you sell your shares to an EOT, there is no capital gains tax at all. So it is obviously, it doesn't get more efficient than that as a means of disposing of company shares. But also when we're looking at this, don't forget inheritance tax. Because this is often something that clients overlook in their natural desire to think about income tax and capital gains tax. They forget about inheritance tax. If you go back to the point I made earlier, if you own shares in a trading company, at the moment, there's a thing called business property relief, which gives you 100% exemption from inheritance tax. So if you have a company that's worth £1 million or 2 million, let's say 2 million pounds, if you were to die, tax on that, because it's turn tax potentially if you died at 40%. So that's a £800,000 liability for your heirs. I mean, there may be other reliefs available, but essentially, you've turned something that was no tax to 800,000 just by your actions. So don't forget inheritance tax when you're looking about company disposals. Next slide, please. So which of these these options is the best for you? Well, as I'm sure you'll won't be surprised to learn, there is no right answer, and it is a question of evaluating all of these things and deciding what's best for you. And this is an area where advice, I think, is quite useful, because most people only do this once. But it's important to factor this thinking into consideration. So size is important in this. The reality is, unless your company is reasonably big, some of the options won't be available to you. So a trade sale is unlikely to be available unless the company is sufficiently large. Equally, private equity, they tend to want transactions which are £10 million plus. Now, I wouldn't use that as a hard and fast rule. It's simply a guide, but gives you an idea of what we're talking about. And the reason that size map is important for those types of deals because of the complexity and cost. It's an expensive business to get a PE sale away, for all parties. There'll be a lot of lawyers involved, a lot of different financing methods. There's typically bank funding, equity funding. There'll be advisors to the sellers, the buyer, there'll be advisors to the management. So there's a lot of parties involved which all need to be paid. You might say, well, is that all necessary? I'm afraid the answer is yes, it is. And so it's a costly business and it's complex. So inevitably, in order to fund that, the deal needs to be of a reasonable size to make it worthwhile. But the most important thing, I think, is before you even get into that, because there are restrictions on what you can do in reality, is to establish what your personal and family aims are. Yeah, and this I think is sometimes too little time is spent on, and probably it's the most important part. So if we're looking at succession planning, if we're discussing passing the business on to your heirs, the fundamental question seems obvious, but I'm not sure it's always asked properly. Do your heirs want the business? They might not, or they might prefer to have the cash, or they might prefer to have it in a different form. So it is important to think about that. It's also important to think about your legacy as an owner of the business. Do you want to pass the business on intact? Is that an overriding concern, or are you more concerned about securing your family's position and getting the best price you can for the business, and you're less concerned about who acquires the business? And I'm sure everybody will want the acquirer to be a reasonable owner of the business going forward, but there are variations on that between how far you want to go in that respect. So those things need to be carefully considered. And there's also the question of de-risking your family. Many business owners, in my experience, the vast bulk of their wealth is tied up in their company, or their business, and that can mean that they're in a pretty risky situation. So selling all or part of the business, passing on is part of a business strategy of de-risking yourself. So sharing your assets around different classes to avoid concentration. So there's lots of things that need to be borne in mind, and all of these factors are important. And as I say, some of them are constraints, some of them are opportunities, but they all need to be considered. Next slide, please, Tony. So I wanted to talk in a little more detail about EOTs, because they're the least well-known probably of these groups. So EOT is an employee ownership trust. An employee ownership trust is a government-approved employee ownership trust. It's not the same as you may have heard things like things called EBTs, employee benefit trusts, are not officially recognized things and were often used for tax avoidance. They're completely different. An EOT is a government-approved method for passing on the business. So I want to talk about, in those headings there, the benefits, the qualifying conditions, and talk briefly about the transaction valuation and how you'd finance the transaction. So next slide, please, Tony. So why do these rules exist? Well, the EOT is a form of employee trust. It was introduced by the government in September 2014. So it's been around quite a while now, and its policy objective is to encourage more shareholders to set up a corporate structure similar to the John Lewis model. So there's employee ownership. And what the government recognised as well is that for smaller businesses, it's often difficult to find a trade buyer or PE buyer due to the size of the business. And this model would be quite effective at allowing those businesses to pass on to new management in a reasonably tax efficient way. And it allows employees to effectively and directly buy the company from its shareholders, but without the employees having to use their own funds to do that, because in many cases they just simply don't have the money. So you can have an immediate sale from your employees. You don't have to wait for. There is an element of waiting in most cases. I'll come on to show, but you're not. It's usually possible to get more money up front than it would from the straightforward MBR I referred to earlier. And the incentive that the government introduces generous tax breaks, which we briefly touched on earlier. So, and some incentives for the employees as well. So we'll talk about those too. So next slide, please, Tony. So tax benefits, so full CGT relief. The benefit for the employees is the employees rather is they have exemption from income tax, but not NIC, for bonus up to 3,600 per year, provided they're paid to all employees. And all employees means all employees of a particular class. It doesn't mean absolutely everybody, but it means you have to use objective criteria. So it's generous, and there's some benefits to employees as well. From the commercial point of view, not all shareholders are required to sell the shares to the CET. So you can have a partial sale if you've got different groups or different generations of shareholders. Perhaps the older ones can sell out, the younger ones can stay in. Although you must have sell more than 50. The EOT must acquire more than 51%, or at least 51% of the shares of the company. So you have to have a reasonably big exiting shareholder population in practice. The important point is with an EOT, the existing directors can remain in situ after the sale and can continue to receive market-based remuneration, which provides obviously a degree of protection, because if you've sold your business to the employees and you're waiting for some of the consideration to be paid to you, which is typically the case, then you can keep your eye on the business, for want of a better way of describing it. On a day-to-day basis, should you choose to. You don't have to, but you can. The EOT is generally friendly a purchaser. It's a more sort of in-house thing. You don't have hordes of accountants and lawyers crawling all over it. You'll have a small number of them crawling over it, but not that many. And it's a friendlier deal. It's not quite as adversarial, perhaps, as selling to a commercial buyer. And there's the benefit of greater employee engagement. The employees feel they've got a stake in the business, and it becomes really important to them. And that can be motivational and good for the business going forward. So next slide, please, Tony. So what are the main qualifying rules? Because as ever with these things, and there's nothing for nothing, and you do have to meet these conditions. So the key requirements are the all employee benefits requirements. All employees have to be able to participate in the EOT. You can't say, I'm going to set up an EOT for just the senior management, and that all employees have to potentially benefit in the scheme. Although you can use objective criteria like length of service, seniority, and pay levels, but at some point they all need to be able to benefit. So it's an equality requirement, which is part of that. The controlling interest requirement is the EOT must own at least 51% of the company. The trading requirement alludes back to what I mentioned earlier, which is the company needs to be a trading company. And the limited participation requirement can sometimes be a problem for very small businesses, because what it says is that number of continuing shareholders who are directors. So if you have partial sale, and you've got some shareholders who were previously shareholders and they're remaining in the business, the people who own shares cannot be more than 40% of the total number of employees going forward. So if you've got a very small business with 3 or 4 employees, that sometimes can become a problem. But it's usually manageable. Okay, so so there's a number of other considerations as well. So important point is the shares must be acquired by the EOT at market value. So you will need a proper market valuation to be performed, because the EOT must pay fair market price for the shares. It can't do it at undervalue, and it can't do it at overvalue, because if you do that, if you sold it at undervalue, you'd be passing to a benefit to the employees, which is potentially taxable as a benefit in kind in some respect. And obviously, if you did it the other way around and took too much out of the company, sold it to the EOT for too much, that's a way of effectively extracting money from your company in a tax-free way, which HMRC clearly don't like. So it has to be done at market value. That's extremely important. But in practice, not too onerous. It's a question of paying somebody to do the job and taking a sensible view on it. In terms of the financing, this is also a very key point, because I'll talk for you a few steps in a second, and they can be confusing. But the key point to take away from this is that whichever way you look at it, the money comes from the company. So this whole transaction is financed by the company in effect, because, as I said earlier, the purpose of this is the employees don't have any money themselves, so the money comes from the company. So therefore, what you need is a company that has good cash generation prospects, because that's what will ultimately fund the EOT, which will buy the shares. So you need a company with good, solid cash flow. It doesn't need to be a fast growth, high growth company. In fact, if it was, you might consider selling to private equity, because you'd probably get a better price. But it does need to produce solid cash flows. And there are important considerations about culture as well, which is, as we'll see in a little while, these structures work best for companies that are where there's already a culture of employee engagement and participation, because you want your team to carry on and run the business, so they need to understand that. So the way it works is the cash goes to a trust, which buys the shares off the exiting shareholders. So the trust needs to be funded. Typically, it's funded by the company. So the company makes a loan to the trust, and the trust buys the shares off the shareholders. So where does the company get the money from? It gets the money from its own resources, so hopefully have a cash balance of some degree. But if it's a business that has good, solid cash flow, it can borrow off the bank and use that funding then to fund the EOT, which then buys the shares off the shareholders. So what we end up with is a trust owning the company, or at least 51% of the company, and the company itself typically owes money to the bank. So as I said, it needs a bank on side, it needs good management, and critically, it needs a business that generates profit and cash. But don't forget, under this structure, the exiting shareholders can continue to be shareholders of the company. So if you have a degree of control and ability to back yourself, as well as the management going forward. So they are very popular in certain situations, as we'll see. So if you move on to the next slide, please, Tony. There's examples here of employee control companies. Some of these are very large, of course, but there have been lots of others. Locally, Aardman Animations, which is Wallace and Gromit, amongst other things. That's a company now owned by an EOT, and we've done them for all different companies in the construction sector, quite small companies, and some very large ones as well. So there's no kind of rule to this. As I said, the costs are relatively modest, so you can do it for smaller situations. It is important to have businesses that generate cash and profit, and it is important to have management that you can pass the business on to ultimately, although, as I said, in the initial phases, you can continue to run the business yourself. So next slide, please, Tony. So in conclusion, there is no right answer to this. EOT I spent a little bit of time on because it's relatively new and unknown, but it's only one of the part of the mix. So the key thing is to sit down, go through all those criteria carefully and decide which is the right answer for you to secure your future. And when you've got to that point, of course, you'll have hopefully cash and you'll need to do something with it. So now's the time to introduce Derrick to talk about what you might do.
Thank you. Thank you, Paul. Well, as Paul mentioned, there are various options open to business owners who are contemplating a succession or exit plan. And ideally, it's good to put effort into planning a succession arrangement sometime before you get there. I can give you an example. Some of our clients who were keen to make large pension contributions, which were to be funded by their limited company, during the course of our conversation, a husband and wife team, it became clear to them, clear to me, I beg your pardon, that they were thinking of selling land and property that they owned for development, but at the same time, they wanted to sell their company. And I actually mentioned if they had explored an employee ownership trust, which they hadn't. So I suggested that they hold back it was around about £300,000, the pension contributions. I suggested they hold back that capital as potentially that could be used to make a stage payment as part of a sale to an employee ownership trust. I'll refer to them as EOT from now on, by the way. Our clients decided to carry out their own investigations into EOTs, and they actually decided that, yes, it was the route to take. So meaning that the 300,000 that was actually paid to them as part of the sale to the EOT, and therefore not subject to capital gains tax. So it emphasizes the importance to plan the end game in order to know the relative place of any existing arrangements that you may have, and the importance of those arrangements in the whole process. If I can have slide 2, please, Tony. So let's assume that one of the sale options covered by Paul has been actioned. You now have a lump sum of cash and possibly further stage payments to come. What now? In any event, getting the most out of your money for money will be a high priority. A lot depends on your requirement for income and access to capital. And are you concerned about inheritance tax and how this wealth could pass efficiently to the next generation? Of course, many people aren't interested in inheritance tax planning, so that may not be of concern. But for those that are, should trusts be used? For example, reversionary trusts, discounted gift trusts, and loan trusts. These are various off-the-shelf trust packages which have been around for many years. The reversionary trust is particularly interesting as it allows an annual access point to the capital without contravening the gift with reservation rule. And after 7 years, the total value of the trust is outside your estate for inheritance tax purposes. The gift with reservation rule, just quickly for those that it's confusing. For example, if you owned a property in which you lived and you gave that property to your children, but you were not paying fair open market rent, then that's a gift to the children with a reservation of benefit, i.e. you're living there scot-free, as it were. So that wouldn't count for inheritance tax planning. So it would be as if that gift never happened. So whether trusts are used or a combination of products such as offshore bonds, collective accounts, individual savings accounts, etc., how do you get these trusts and products to work for you? Next slide, please, Tony. we found that many people have a financial advisor with whom they might meet once a year to review their financial investments, and adjustments might be made to the underlying holdings. But quite simply, what has this got to do with macroeconomic events that would impact on valuations during intervening periods, such as the current horrific war in Ukraine? A discretionary portfolio management service monitors your investment 52 weeks of the year and makes any necessary adjustments to your portfolio without bothering you. Firstly, time is spent to put together a strategy for what could be multiple investment plans. This would include discussing the subject of risk and what is the most appropriate level of risk to be taken. It could be that plans be managed with differing levels of risk. We just recently set one of those up, an offshore bond for a client who actually has recently gone through the EOT process. And whilst the bond sits in the jurisdiction of Southern Ireland, the content is managed 50-50 between two different risk levels. So that can be done. So when the strategies evolve, plans are then set up and proactive management commences. This means that asset allocation is determined. So how much exposure should be given to such things as UK equities, international equities, fixed interest or debt, and indeed property. Once the asset allocation is known, then we carefully, after applying a few criteria, select our choice of funds to invest in. Asset allocation and fund selection is then reviewed every week of the year, and adjustments can be made at any time. Quarterly investment reports are produced comparing your portfolio performance against an industry benchmark. We can set up a document library for clients where these regular reports can be electronically stored. And indeed, clients would have 24-hour online access to live valuations. If your circumstances change, then a review of all arrangements can take place at any time. In any event, we would prompt you annually to let us know of any material changes to your circumstances, and indeed to make sure that the level of risk being taken is still relevant. Overall, discretionary investment management gives you peace of mind, knowing that your portfolio is being constantly monitored and any necessary action is being taken on your behalf. A proactive investment service is particularly important at the moment with all that's going on in the world. So finally, what should you be looking out for when selecting a wealth manager? Apart from the obvious of working with someone you like, try to find someone whose success depends on doing well for you. Someone who takes a keen interest in you, your family and business, and who takes time to understand your overall situation. Someone who has a passion for their role and hopefully can back it up with good results. And that's my piece done. So thank you for listening. And I think we might have a few questions to go through. I think from my point of view, I've got one here. Who sets up any trust? Well, the trusts that I referred to, which were discounted gift trusts, loan trusts, and reversionary trusts, are what we call packaged trusts. And these have been set up, engineered by insurance and investment companies. And these companies have paid an awful lot of money for a tax opinion and a legal review as well. And these types of trusts are set up only by financial advisors who are authorized by the Financial Conduct Authority. So whilst solicitors no doubt would understand them, and by the way, can obviously set up trusts, these particular products have to be set up by someone who's regulated by the FCA, the Financial Conduct Authority. So that answers that one. Next question I've got here. Why did you decide to set up your discretionary portfolio management service? That's a good one. Well, it's a subject which since '91 has evolved, and we've gravitated more towards giving our clients investment advice, and it's a subject which we love. And rather than, it's easy for an advice company, by the way, to set up a product, farm out the actual investment management to a third party. And, you know, that's good, bad, or indifferent. But I like to look a client in the eye and be totally accountable for the actual decisions that we put forward, the investment decisions. So that was the main reason. It also helps when you have hundreds of clients to deal with. If you need to switch from fund A to fund B, you can do so at speed and treat all clients with equal fairness. Historically, you know, or those advisors that don't have that permission actually have to send a document to a client, justify why the switch is recommended, and ask the client to sign a form to return so that transaction can be conducted. Imagine doing that with a few hundred pieces of paper flying about. It's chaotic. So, but most important, it's really for direct accountability, which you know, the buck stops here. So I think that was my questions. I don't know if there's any others. I think you might have some, Paul.
Yeah, bear with me, sorry. Yeah, so the questions I've, two have been asked actually. So first one is, you said, I said there's no tax, you said there's no tax on an EOT. This seems too good to be true. Is this tax avoidance? And I think this is it's a fair question, because it does seem very good, a zero rate of tax, and would I be criticised for tax avoidance for doing such a thing? And I think the answer to that is no, you wouldn't, because this isn't a government approved scheme, and that's a really important point to remember. EOTs are government approved. The whole system has been established by the government. There are some clear rules that you need to conform with to be a qualifying EOT. So I don't think anybody should feel bad about this. It's there to move the business on to a new group of management. That's an important thing to do, and so there's no tax avoidance in it. It's government approved. And the other thing really that relates to that is, as I said before, it's really important that you have the right type of business and the right type of management to do this. They work best, in our experience, where you've got a existing culture of involving at least the next level of management in decisions, bringing them on so they take ownership. These things will be much more likely to be effective in the right commercial setting. So it's not just about tax. And there's one other question as well. Do you think inheritance tax rules are going to change? There have been lots of rumours. There are always rumours about inheritance tax, and there have been various papers produced. The all-party parliamentary group produced a paper on inheritance tax about 15 months ago, which set out some basis for reform. The all-party parliamentary advisory group is just that. It's not of any statutory footing, but it does have a voice to government, so it's influential. And there have been various consultative documents and reports by the Office of Tax Simplification as well on the subject. But so far, nothing has happened, which is in itself interesting, I think partly because it's difficult and unpopular. The only thing I would say is at the moment, the inheritance tax system is quite benign. It's particularly if you've got shares in a trading company, as I referred to earlier. So you can pass assets on to your heirs if you choose to, in a relatively efficient way. And I would have thought that if any changes that are made aren't likely to become better than that. Let's face it, at the moment, you can pass shares on in a trading company and pay no tax. There's no way that you can do better than that. So, the possibility is, and I only say this is a speculation, not fact, but the possibility is it's more likely to get worse than better. So if you're in a suitable point in your life to think about inheritance tax planning, it would be probably a good time to do it now. I don't think we've got any other questions, Tony, have we? No?
think that's it.
No, don't think so. No.
I don't think there are. No.
No. Okay. In which case, thank you for your attendance today, and we will wrap up the presentation now. Thank you for your participation.
Thank you.